Do you want to know what financial analysts think about the stock market right now? Let me grab this from the printer. I just got some few quotes, okay? Here's the first one. Of course, with stocks at the all-time high, some seem to have nowhere but to go down. Quote from Goldman Sachs, printed in Business Insider. Next one. At valueengine.com, we show that 77.8% of all stocks are overvalued. 45.2% by 20% or more. All 16 sectors. I thought we had only 11. Anyway, are overvalued. Consumer staples by 17.6%, retail wholesale by 26.4%, and utilities by 9.8%. That's coming from Forbes. And last one, the market has jumped by nearly 30%. This means stocks market rally has been based solely on people paying more money for the same amount of earning. This is known as PE multiple expansion. That is coming from Multifool. So you know what? You might as well just cash at least 30% of your money and wait for a pullback. The market crash is definitely coming in 2020. Really? Okay, I'll tell you why you're wrong if you're putting money aside and wait for a pullback. This is probably like one of the biggest mistakes you could ever done for your portfolio. I'll tell you why in a second. Dividend investors, bonjour, this is Mike Giroux, founder of Dividend Stocks and passionate investor. First, I want to tell you, happy Valentine's Day. And now you're watching this video and you're saying, oh my God, I completely forgot. Well, you did, because I definitely recorded this video on Valentine's Day, but it's not published on Valentine's Day, so you're definitely late. And if your spouse is not talking to you for a couple of weeks, now you know why. So now if you have believed the quotes I just read you, you're right and wrong at the same time. You're right because they did existed, they were said, but they were all coming from 2013. This means that if we had this video back in 2013, you would be willingly putting 30 to 50% of your money on the sideline in a low interest account. I know they're calling it high interest, but really 1.52%, you call it high. So basically, you stash your money there in 2013 and you wait for the pullback. Fast forward today in 2020, it's been 7 years that you're waiting for that famous pullback. Do you think you're gonna get your money back? I don't think so. So today we're talking about this, what I would call an invisible mistake. It's an invisible mistake because you are making a mistake, but in fact, you do not see the impact. You do not see that you're losing money right now. And this is called waiting for a pullback. So first, let's determine why you're doing this. For any mistakes, for any wrong behaviors that we do, it is important to first understand what's wrong in the first place. So while we're doing this, while we waiting for that pullback, well, let's bring out a chart right here showing the past 20 years on the stock market for both Canadian and US. Over the past 20 years, we had a chance, if you can say it that way, to run into the tech bubble, the Twin Tower terrorist attack, and the 2008 financial crisis, and finally the oil bust in 2015. During all those crises, you can clearly see the market going down, and if you were able to capture those market drop, you would be making lots of money. So basically what you say is, I'm gonna park the money aside, and while I'm doing that, I'm not losing money, so that's a good thing. So what you do is keeping your money aside, waiting for that next pullback, and you're just thinking, well, why should you buy now when you should buy at a cheaper price later? So all this money is parked in a low interest account. You don't lose money during that time, so you don't feel like you're making a mistake, because basically if you stashed $100,000 there, well, you know what? A year later, it's still $100,000 plus a few bucks in interest, right? But it's never gonna show $90,000 or $85,000. We all think that we could invest on March 9th of 2009. I don't know why, but for the past decade, everybody refers to a market crash thinking of the 2008-2009 financial crisis. So obviously, if you bought at the bottom of the market on that day, today you feel like a genius. The US stock market went up by more than 500% and the Canadian market went up by 200%. So basically, pretty much wherever you put your money back in March of 2009, you made a lot of money. In most cases, for most investors, if you played your card right 10 years ago, you're probably set for life. Your portfolio is like filled with high quality stocks that surged during the past decade and you just feel like a genius. So everybody that didn't have that chance back in 2009 is just thinking, oh, I'm gonna wait for the next 2008 to happen and then I'm gonna put all my money in and I'm gonna feel great about it. Well, this is why it's going to hurt your portfolio. The problem is 2009 doesn't happen every 5 years or even 10 years. It actually only happened a couple of times throughout the past 100 years. So basically you're just waiting for something that will likely happen as the Habs will win the next Stanley Cup. That happens every 25 years now, right? When you look at the S&P 500 history from the 30s to today, you will notice that very, very, very rare are the occasion where you can benefit from a huge pullback. We had one in the 2000, we had one in 2008, but before that, you have to go back in the 70s before having this kind of opportunity. So basically, since 1970, you only had 3 occasions to benefit from a huge pullback. This means that the next one will likely happen next year or in 10 years. And most people forgot that we had a pullback in 2018. So it's only 2 years ago, and most of you probably didn't even look at it. You thought that 20% from the peak level wasn't enough to put your money in. So probably that nobody invested, or maybe like a couple of lucky people, invested on December 26, which was the market bottom. You know what? I did a little calculation just for fun. When I quit my job in 2017, I received over $100,000 as the commuted value of my pension plan. I received a check in September of 2017. Obviously back then, market was overvalued, all-time high, yada yada. Don't invest, wait for a pullback, right? I decided to put all my money in. I've selected quality dividend growth stocks and just invest the entire amount within 3-4 months. What I did after 2018 is I did some calculation to see what would have happened if I had kept 30% or 50% of my money in cash and just wait for that pullback. And imagine that I'm a super genius and right after I finish clean up my Christmas table on the 26th, I would open my broker account and then put my 50 or my 30% cash into the market right before the market start rising to an incredible years in 2019. Well, guess what? The money I made between 2017 to 2018 market crash, it was more than enough to compensate whatever gain I would have made based on the 26th till today's date. If you want to know more about this small case study, you can read it on my blog. I've put the link right down below. I know it's a one case history. It's not going to make a public study. We're not going to be able to submit that to any university. And it's not a trend, it's just a unique situation. But still, it tells me something about what happens in real life with real money. If you focus on dividend growth stocks, on high quality companies, you don't have to worry about the next pullback. You don't have to worry about the stock market crash and making money later down the road. You know why? Because regardless of what's happening on the stock market in the next year or in the next 10 years, what I know is I'm still getting paid. I'm getting paid each month, each quarter, and you know the best part of it? My paycheck is increasing all the time. Coming from my latest dividend income report, let's just look at how my dividend payment has evolved throughout time since I started that pension plan. All right, so what you can see on that chart is the total of dividend paid each month since I started my portfolio. What you can see clearly here is my payments are increasing month after month. So instead of looking at the stock market, instead of looking at how much I lost in 2018, I just focus on how much I made in dividend payment. This allowed me to sleep well at night, and in fact, I actually ended up 2018 in positive returns. You know why? Because the dividend were more than enough to compensate for what I lost on the stock market. So basically, here's the thing. If you have money, the best timing to invest is right now. Not tomorrow, not after the next Fed decision, not after the trade war is done, not after the next election, right now. Just invest your money, take the time to select strong dividend growth stocks, and you'll be fine. Now, if you're looking for some ideas to start your portfolio or to start injecting money in the stock market, we have selected the best stocks for 2020. You can just click on the link below, look at our selection, get some ideas, and start researching a little bit further. But the most important part is you need to take action now, because you know what? Maybe we just had a pullback in 2018 and we're off for another 10 years of bull market. How would you hate yourself if you wake up in 10 years and you haven't invested your money? Waiting is not an investing strategy. So I hope that you're going to take action today, and until the next video, stay invested.